Hi, this is Professor Karen Lin. Welcome to the Financial Accounting for Undergraduate Students. In this video, we are going to explain Chapter 4, the second topic, Closing Entries. Let's get started. To start the topic, let's first take a look at the linkage between the financial statements. A balance sheet reflects asset equals to liability plus stockholders' equity. The balance sheet is a snapshot of a company we talked about in the previous chapters, a snapshot of the company on a particular day, for example, as of December 31st, 2022, which means if you look at the cash account, let's say the cash account has $1,000 in it, it means as of December 31st, 2022, your company has $1,000 in cash, which is either the cash notes or the bank deposits. So balance sheet reflects the financial status at the end of the year. Income statement, on the other hand, it's always for a period of time. So income statement is revenue minus expenses equals to net income, and the net income measures the financial performance of the firm, which means the profitability or any losses of the firm during that period. Now we talk about periodical assumption. A firm could have accounting period of a month, a quarter, or a year. So how does these two financial statements get connected, right? One financial statement basically carries over all the effects from day one of this company until the date, say as of December 31st, 2022, means it's the impact reflects the impact from day one of the company to December 31st, 2022. On the other hand, income statement only reflects the effect of 2022. The connection between these two is through something called retained earnings, which is the earned capital. We talked about the expanded transaction analysis, the equation in the past. So retained earnings at the end equals to retained earnings at the beginning plus net income minus dividend. So the ending balance of retained earnings will eventually be reported under stockholders' equity as of December 31st, 2022. And this as of number includes the period between January 1st, 2021 to December 31st, 2021, which is the whole year. Okay, let's assume the company used a year as a financial accounting cycle. So net income measuring 1 year of financial performances will eventually flow to the retained earnings included in the ending balance of retained earnings and be reflected in the balance sheet. All right, here is a simplified example. In this example, let's assume during the period, the company has a net income of 1,000. Okay, 1,000 for year 2022. How does this be reflected in the balance sheet? If we look at statement of shareholders' equity or stockholders' equity, let's assume there's a common stock, 50,000. When the investors initially invested in the firm, there's no premium they paid. So therefore, APIC, additional paid-in capital, is 0. And they have a retained earnings, 30,000 last year, right? This is their last year's retained earnings, so it will be reflected in the beginning balance. During this period, the company earned $1,000 in the form of net income. This $1,000 will be included when calculating the ending balance of retained earnings. So the $1,000 will be added to the beginning balance. The ending balance of retained earnings will be $31,000. Now this $31,000 will eventually be reflected in the stockholders' equity as of December 31st, 2022. Okay, this means the 2022 financial performance will be included when we report the end of year balance sheet. Where does it is it reflected? It's reflected in the account called retained earnings at the end of the period. All right, so I would have you review this chart by yourself, trying to understand how the periodic income statement, which only relates to this period, is linked to the balance sheet, which is related to all the periods starting from day one. Because the income statement only relates to the financial status of a particular period, in this example, a year, these accounts has to be closed at the end of the period so that next period they start fresh. Before we talk about closing, I want you to first understand the two concepts related to closing. Balance sheet accounts are permanent accounts. As we talked about on the balance sheet, all the financial effects are cumulated. So these accounts carry over all the past effect. For example, a cash account is an asset account. In an asset account, cash continues from previous period, adding or subtracting by the current period's transaction. So at the end of the day, you will be basically adding the prior period's effect of cash, which is implied in this beginning balance, and to find out the ending balance of cash. All right, so cash is cumulated or it's permanent. On the other hand, income statement accounts are temporary because they only relate to one period. You will see this is a sales revenue account. The balance 1411 is related to only the transactions for the current quarter, in the Chipotle's example. So at the end of the period, we want to cancel that out. We want to make the ending balance of revenue 0 because next period we start over again. So this is like resetting your computer, okay? You're going to reset your computer and preparing for the next period's operation. So that's the idea. Now, when we close the book, obviously, you only close temporary accounts. You will never close permanent accounts. Permanent accounts do not close. So how do we close? When we close the accounts, we transfer the balances in the temporary accounts into retained earnings. And we also try to establish a 0 balance in every single one of the temporary accounts so that they start fresh in the next period. Here is an example of the closing entries. Now, if you look at the adjusting trial balance, first of all, stop here for a second. What is the adjusting trial balance? Adjusting trial balance is the trial balance that reflects all the adjusting entries. Remember in the previous video, we talked about what if we have unearned revenue from the last period and this period we fulfill with services? We recognize revenue from the unearned revenue. So when that happened, we change the unearned revenue account, we change the revenue account. So after we did all those, posting those to the T accounts, we will prepare a new set of trial balance. That set of trial balance is called adjusted trial balance. Compared to in chapter 3, we talk about unadjusted trial balance. All right, so adjusted trial balance are the trial balance is the trial balance that got adjusted after the end of the first 3 steps of our accounting cycle. All right, so here is just some selected T accounts. For example, if you look at service revenue has a $180 ending balance, which is reflected in the adjusted trial balance. So this adjusted trial balance indicated that the service revenue T account has 180 on the credit side, right? So this is the T account that reflects this. But remember our purposes. Our purpose is to make the service revenue goes to 0, right? Because we want to start fresh next period. We talked about in the previous slide. So how do I make a credit balance become 0? Easy, right? You debit the same amount, then it cancel the debit and credit, they cancel out with each other. So in order to close a sales revenue, we will debit exact amount on this adjusted balance. We debit 180 to cancel out with the credit side. Similarly, you would like to when you like to close an expense account normally has a debit balance right here, the wage expense, $60 on the debit side. If you want to make the debit side go to 0, you would credit, right, the same amount to make it go to 0. So I would credit the wage expense for the same amount. All right, now the question comes. When I debit a sales revenue for $180, what do I credit? What do I credit? Remember, which one is the account that connects the income statement and the balance sheet? You got it. It's the retained earnings account, right? So in order to close the income statement account, everything flows through retained earnings. Therefore, we are going to, if you have a retained earnings account, you will see when we debit 180, right? Let's say if I have a retained earnings account, I know it has a retained earnings account on this page, but I'm just going to write it out so that it's easier. So when I debit revenue for 180, I credit retained earnings for 180. That makes my previous statement true. When I have a debit, I have a credit, and they have the same amount, right? Similarly, when we credit the wage expense for 60, so that we make the wage expense go to 0, we would debit retained earnings for 60. We credit loss of the assets 10, we will debit retained earnings 10. We debit interest revenue 10, we credit retained earnings 10, right? So always on the other side and then the same amount. To make the supplies expense go to 0, the balance was 30, so we credit supply expense, then we debit retained earnings. Okay, these are all the effects that reflects in the retained earnings account. So on the credit side, the effect was 190. On the debit side, 60 plus 10, 70 plus 30, that's 100, right? So that's 100. So 190 subtracting 100, the net effect is 90 on the credit side. So you will see in this closing entry, we debit service revenue, right? 180. And then interest revenue, we debit 10. Interest revenue 10. We credit wage expense 60. Credit supplies revenue 60. And then credit loss on the sales of assets 10. The net effect is shown here is 90. So we have 90 in the retained earnings that should be included. So this is an overall retained earnings account. You will see that before the closing. So this is before closing. This 800 is before closing. Before closing, retained earnings has $800 in it. The closing added 90 to the retained earnings. So at the end of the day, our ending balance of retained earnings would be 890. All right, that was the simplified version of the closing entry. In the example of Chipotle has many more revenues and expenses accounts that needs to be closed. So you would see at the end of the day, the retained earnings change because of the closing entries, and all the temporary accounts after closing becomes 0. After closing, we would prepare a trial balance again. In this post-closing trial balance, guess what are the balances of the revenues and expenses? Yes, you got it. Post-closing trial balance would not have any revenues and expenses account because after closing, revenue expenses all go to 0. All right, so you could watch the guided help video 4-2 if you need more details of closing, or if you feel you want to refresh your memory again, you're welcome to watch that video, but the idea of closing is included in this video. All right, I'll see you in chapter 6.